My father is officially retired. He still helps a lot with what we're doing, consulting, advising, guidance. He's been a real estate investor since the 1970s. And so learned a lot from him.
What is your process for vetting an operator? So you have different asset classes and you're like, man, I got to find one or two really strong operators. You're looking for conservative deals. You're also looking for probably a certain amount of consistent deal flow from these operators so that you can grow your fund as well. But what is your process for vetting new partners?
Yeah, it's evolved over the years. As you can imagine, when you start out as a small LP, you're going off of a referral predominantly from a friend or a colleague or someone that has already invested with them and has done well. And then I'm a financial analyst by trade, Michael. So I ask a lot of questions. I dig into the math. I like looking at Excel spreadsheets, but I've owned and operated a portfolio of real estate across multiple states for many years. And so I understand the operation side as well. So those two kind of skills, I'd say, really help me look at how other people think and analyze and operate real estate. And so over the years, we've evolved. I'll say this: there's a lot of steps in the process for us, Michael, to get comfortable with a new group. It mostly today, if you're not referred to us, or if we don't have an investor saying, "Hey, these guys are awesome. I've been investing with them for many years," it's going to take a lot longer to get comfortable with just about anybody because they're new to us. And we have, over the years, Michael, vetted and underwritten, gosh, probably over 130 operators in different asset classes. And so we have a pretty good depth of knowledge of who's who. We don't know everybody, but there's a lot of people on that list that we work with and some that we don't and others that we won't. And so that process starts with, who are these people? How long have they been in business? What's their pedigree? Track record, experience is critical today. We're not typically working with groups that have less than 5 years of track record. We like to see exits, and we like to understand the story behind those exits. Were they able to grow net operating income manually by doing a lot of things, or were they the recipient of cap rate compression? Is that what got them a great return? And there's no wrong answer here. It's just trying to understand them a little bit better. Obviously, if they have some type of special sauce, what makes them unique? Let's learn about that, right? And so we've got a couple operators that I think differentiate themselves from others. For example, one of them has a team of 6 full-time people. All they do all day long is cold call self-storage and mobile homeowners. And they've been doing that for 15 years. And so they have a Rolodex of mom and pop operators that they've established relationships with. So they get their deal flow usually not with a real estate agent involved, and usually off market, direct to seller. A lot of times that produces really attractive opportunities. And so we like that special sauce, right? That's just one example of the people and their operations and how they source deals. And so that's one aspect of it. And then we can get into underwriting as well. But I think pedigree is important. We look at references, background checks, both professional references and organic, I call it, where I go and try and find people that the operator doesn't know I'm talking to and ask them about them and try and get more of a candid response. And we also look, of course, very deeply at, when I said track record, a lot of times we'll look at the portfolio that they're currently operating. How's it doing? Show us, in detail what your initial projections were and how it's actually doing today. And are you above, below, at projections from a cash flow, from a net operating income growth standpoint? Do they have a cluster of properties in one market? That can be special sauce, right? They might maybe own thousands of units and operate thousands of units in one submarket. Well, they're going to know the rents. They're going to know the comps. They're going to know the demand. They're going to understand some of the nuances, like, do we have to give concessions? Do we want to be west of Main Street or not? All of these little nuances make a huge difference. And so we're looking for something special versus just kind of a generic, hey, we're an operator in this asset class. We've been in business for X number of years, and we buy Class B value add workforce housing in the Sun Belt region. I mean, there's how many times I've heard that. It's like it's it's a very competitive space. So what makes you special and different? So I'll see if that's a good amount on the people. And if you want to talk about underwriting, I'm happy to as well.
Yeah, I'm actually curious about if you talk about a story where a partnership did not work out well. Right? We talk about a lot about our successes, and partnerships are really awesome when it's 1 + 1 = greater than 2. And then sometimes they can be awful. Like I'd love to hear just a little story about maybe a partnership without getting specific about that didn't work out.
Sure. Yeah, I've got one in mind. So this is a repeat operating partner we had personally invested with and raised capital with through our company in that order. And remember, we were looking at a new deal that they were giving us to potentially raise capital and invest with them. And they had a growth assumption of rent growth, Michael, that was, it didn't jive with me. It stuck out too much. And this is in self-storage. So you can see pretty high rent growth assumptions because you can adjust rents within 30-day notice in self-storage. And you typically have, an average 10 by 10 unit is renting for about $120 a month, give or take. So to raise it 10%, the percent sounds high, but it's $12, right? And so not a lot of people are going to leave for $12. But they showed us this growth assumption. I said, listen, I want to take a look at your whole portfolio. What has been your rent growth historically? List out, annually per property. And it took me a while. They would not send it to me, Michael. Finally, they did, because I think the number was like over 12% that they were telling me they're going to be able to grow rents. And I was like, gosh, this seems high based on what we've seen. So they sent me the list. Here's the properties. Here's how much rent growth we've been able to achieve. And there was, 2 giant outliers. That one of them was a development deal. They just built it, and so they were showing it was like 65% rent growth. And the other one was like, I think it was like -3%. They actually had. So I removed the outliners, and what was the average? The average was 2 to 3%. So why are you showing me 12, right? And so that was a bit of a deal breaker to me. I felt like they were hiding the truth as to how much rent growth they've actually been able to achieve. And so we stopped investing with them at that point, and that was a good decision. And so that's one relationship that trust, transparency is just critical. And if people start doubting you, they start doubting your transparency or whatever you're sharing with them, and they think maybe that this isn't true, it sounds a little fishy, that's it. That's kind of a nail in the coffin for us.
Yeah, integrity is it's so important. And sometimes you got to pay attention to the little things, the little flags that you see, because if people kind of bend the rules a little bit in small things, they're going to bend the rules in a big way for much bigger things. So we've had similar experiences as well. But I wanted to ask you about your strategy to move away from operations to basically more of a private equity company. And we see this in multifamily syndications. We see a mix of operators and more private equity groups. People who move to private equity eventually become operators because I want control. I want more slice of the pie. I'm not getting enough equity just by being an investor for another operator. What was your pro and con analysis for saying, hey, because you probably talked about this with your family, we can continue becoming operators, and instead of doing little small houses, we can just do big, larger apartment buildings or get into self-storage ourselves. And you said, no, we're not going to do that. We're going to become a private equity company. What were some of the considerations to that decision?
And you're right, Mike. I've seen this. Different colleagues of mine go different routes. There is no one size fits all, right? You got to do what's best for your personality, your character, what you like to do, what your strengths are. I mean, all of those come into play, of course. So for us, I can speak specifically, first of all, our experience was heavily in single family and small multifamily, called 12 units or less, Michael. And we were focused on distressed assets. And so the supply of those properties was diminishing for years. We knew that. It was writing on the wall. And so we knew that at some point, these deeply discounted assets would no longer be deeply discounted. And so it was always in the back of my head, okay, well, what are we going to do? How are we going to pivot and when? Meanwhile, again, we had invested, myself and my family, in over 20 different other asset classes as LPs during that time period. And so we had data, we had trends that we could track and say, okay, well, look, these asset classes are actually doing really well as a passive limited partner. Why are we busting our butt to go and get 15% and knocking down all these doors in an asset class where we think that the margins are going to continue to get squeezed? It's also historically been more prone to valuation declines during recessions. And we thought there was a recession coming soon. Again, this is 2016, 17. And so we decided to put out a mobile home park deal to our investor network. Let's see what they think about this from a repeat operating partner that we'd been personally investing with. And they loved it. They wanted to be diversified. They wanted to, be on the other side of recession resistance instead of being correlated. They wanted to be uncorrelated. And so that messaging was definitely absorbed quite well. And so that was a big part of it. It was a little bit of a test to see if can we even do this because we wanted to. I personally, our motto has always been diversification since day one. And we create funds to help do that. And a lot of times when we were the operator, we'd create funds of our own properties, or we'd put together, 4, 5, 6, 7 properties into one portfolio so that if something didn't work in one of the assets exactly how we planned, the other one could possibly make up for it and help reduce risk. And so that's been a big part of it. But we decided at that point to shift gears, focus on diversification, focus on the relationships that we'd built with operators, and spread out our capital across different asset classes and people, of course.